Fixed rate, variable rate, tracker. Mortgage rates. Everybody's asking what to do and what do they mean. Hi, my name's Amanda Walker and I'm the mortgage coach, and I'm here to help answer your questions. Now, at the moment, the most asked question I get from my clients is what to do. What to do with the current rising interest rates on mortgages. Now, I wanted to take a step back and actually explain what the differences are because a lot of people don't understand. Now, when you're looking at a fixed rate is exactly what it says. This will be fixed for a certain period of time. So you can have a 2-year fixed, a 3-year fixed, or a 5-year fixed. Now, whatever that rate is, be it 5%, 5.5%, whatever it is, that will be the rate for that period of time. So you lock yourself in. You can still have a term of the 25, 30 years, up to retirement, but this is the time of the deal. And this is exactly how much you will pay month in, month out for that period of time. So if when you organise your, say a 5-year fixed, whatever percent, and it's £1,000 a month, that for those 5 years, it's every month going to be £1,000 a month. So that's fixed rate. Now, the next one I wanted to talk about that everybody's talking about at the moment is the tracker. Now, a tracker is normally, they'll say it's a tracker at 0.69 or a tracker at 0.75 or a tracker at 1%. What they actually mean is whatever the Bank of England rate is, the tracker will be that rate plus the 0.75 or the 0.65. So when you actually go to look at getting a mortgage and you look at the tracker, it will say, oh, the tracker is 3.75, for example. Then you actually look at the ESIS or the mortgage illustration, and a mortgage advisor can help talk you through this. And as you read down the illustration, it won't say the rate is 3.75. It will say it's 0.75 above the base rate, the Bank of England rate. And based on that, you will then know what the rate is. But because it tracks the Bank of England rate, it moves with the Bank of England rate. So if the Bank of England rate is going up, then the tracker will also go up. If the Bank of England rate is going down, then the tracker will go down. So you can take advantage of it when it's going down, but then obviously you pay the price when it's going up. Rather than, if you compare that to the fixed, I explained before, how that will work is if you've got it fixed at a particularly high rate, because as of today, interest rates are quite high or higher than they were, last year or even several months ago. Based on that, if interest rates do go down, as an example, if you're on the fixed rate, you can't take advantage of that. You are stuck on that rate for whatever time you're in the deal. But if you're on a tracker, then you're not stuck on that rate. Now, the next thing I'd like to just unpack is ERC, which is early repayment charges. Now, basically, when you are on a fixed rate, you will probably have quite a high, it can sometimes be 2-3% of the whole loan, depending on how many years you are into the fixed rate. You will have to pay an early repayment charge. So, for example, if you're in a 5-year fixed and after a year all the interest rates plummet and you're like, I want to leave this fixed rate and go on to another deal, your early repayment charges, and again, it's in the illustration in your ESA, and ask your mortgage advisor to break it down for you. They'll be able to tell you if you leave this 5-year deal after 4 years, then it'll be a certain percentage of the loan you'll have to pay back. If it's after 3 years, it'll be a certain percentage, and on and on and on. Now, basically, the way it works is if you leave after a year, the interest rate, the rate that you'll have to pay, it could be like 2-3% of the mortgage loan. If you leave after less time, like literally maybe a year or 6 months before, you may not have to pay anything or a much smaller amount of the loan. So again, if you've got any questions, put it in the chat. If you have any more questions about mortgages, I've got quite a lot of videos on here now. So please subscribe and do the notifications. You'll find out when I'm doing more videos. And yeah, it'd be great for you to put comments in, and then I can do other topics, whatever you're looking to do. Now, back to the tracker. Now, with the tracker, there are some lenders out there that are doing no ERC fees on their trackers. So what that means is, if you're on a tracker, for instance, and the Bank of England rate goes up a little bit too high, and then obviously the tracker also goes up, and you think, do you know what? The tracker is pretty much the same as the fixed rate now. I'd be better off on a fixed rate. Or they start offering discounted fixed rates, and I'll explain what that is in a moment. Then, because you've got no early repayment charges on the tracker, and again, look at your ESIS, it will tell you whether this tracker has no early repayment charges or it does. And if you don't understand the ESIS, again, get a mortgage advisor to explain it to you. Then you can leave that tracker and go on to a fixed or a variable or a capped or whatever you want to do. So there is that option. A lot of my clients at the moment are going on trackers because the interest rate is lower than on a fixed, and they're just holding out for when the fixeds go down again. Because as they say, what goes up must come down. The only thing is, haven't got a crystal ball, so I don't know when. The next thing so we've discussed fixed rate, we've discussed variable rate, tracker. Let's now talk about variable rate. Now, the best thing to understand with a variable rate is very similar to a tracker, but it also takes other things into consideration. So the variable rate will, or could, I should say, it could move based on the Bank of England rate, but it really does depend on the lender. The lender will stress test it as well, and they will look and decide whether they feel that this rate is a good rate for them, i.e. Does it give them enough business, does it give them not enough business, that kind of stuff. So basically, you've got all the high street banks that once the Bank of England rate goes up, generally speaking, the variables do go up as well, and all the rates go up. So a tracker has to go up, a variable, depending on the lender, may go up. Now, you have got some building societies out there that it's they want more business, so they want more mortgages, people coming through their doors. So if all the high streets, because the Bank of England rate went up, all the high streets who have got enough business, they're good, they will also go up as well, because they can afford to go up and lose clients if they need to. But some of the building societies won't go up, or they won't go up as much, because they want to be sourced. And this is when you look at all the rates that are coming. What us mortgage advisors do, we source it, and whichever is the best rate and the best deal. So that's a combination of the rate, booking fee for actually getting the rate, and all the other fees that go along with the mortgage product. Then they may decide not to raise the interest rate as high as maybe the Bank of England rate has risen, because then that way they get more business, don't they? If all the high streets raise it by, say, 1, 2, 3%, whatever the scenario is, and then some of the building societies or some of the other lenders, depending, who want more business, may not rise it, may not increase it by the 1, 2, 3, may only increase it by 0.5% or 1%. So that is why it's good to get an all-round view, look at all the banks, all of the building societies, and find out who is offering the best deal at that point in time, as opposed to a lot of people remortgaging literally just go back to their bank, and that's not always the best deal. So we've talked about variable, which incorporates the Bank of England rate possibly rising, but other things as well. I've talked about the tracker, which literally is set whether the Bank of England rate goes up or not. We've talked about the fixed, which once it's decided, it is fixed. Now, you've got things like, obviously with the variable and with the tracker, if and when the interest rates start to go down, you can take advantage of that, because, you know, they obviously the variable, depending on what the lender wants to do, could possibly go down. The tracker will go down. The fixed obviously will not move because it's fixed. But you could do something which is called a capped rate. And a capped rate is it's like a ceiling. So basically it says it can't go any higher than, for example, 5%. So as the interest rate goes up, your rate can go up, but then it will hit a ceiling. It will be capped and it cannot go any higher. But there is no floor rate. So what I mean by that is it will hit the ceiling and can't go any higher. But if the rate then starts to go down, by rate I mean Bank of England rate, then they can take advantage of that because the rate can go down as well. But it just can't go up. So worst case scenario, but it can take advantage, unlike the fixed, which is fixed. If the interest rate goes down, it's fixed at whatever rate it was. So it can't take advantage of that unless you leave and hope that you haven't got any high early repayment charges. But with a capped rate or a ceiling rate, worst case scenario, that's the worst it'll ever be. But you can take advantage if the interest rate goes down and that rate goes down. So that's that. And the next thing is just a tip about discount rate. Now, sometimes it will say a 2-year discount. That doesn't mean that it's a 2-year deal. It could be a 5-year deal. So you just need, again, to look at the illustration, read the ESIS, which is the ESIS, and it will tell you all the information you need. And it will say, it's discounted for the first 2 years, and then for the next 3 years, it is such and such a rate. Just be careful of those, because when you look at the discount, you think that is the rate, but that isn't going to be the rate past the 2 years. And if you've got early repayment charges on, say, 5 years, once the discount once there is no longer a discount after 2 years, whatever the rate is, 3, 4, 5, you're tied in, which means you might possibly, again, depending on the ESIS and the illustration, have to pay early repayment charges. So whenever you're getting a mortgage, please read that document because it's very informative and it tells you exactly what you need to know. So I hope that has cleared up any misunderstandings about fixed rates, variable rates trackers, and also, as I mentioned, discounted rates and capped rates. Now, there are a couple of others like offset rates and things like that. And if you want to know more about different rates or you have any questions on rates, please feel free to put the comment in the chat, and please subscribe so you know when I'm doing new videos, because I do videos about money and mortgage matters every week. There's a new video. So if not one, there's two. So yeah, by all means, subscribe, and I'll look forward to seeing you next time.